I think it's very difficult to lose money if you do stabilize B and C asset classes all across the nation, but certainly in Florida, right? You're buying assets that are 95% occupied. The beta is going 15% a year. You can do nothing and basically your asset will increase before the leverage 15%. You would have to do something really, really stupid to lose money.
This episode brought to you by Suites at Madison. Meeting and conference rooms for rent by the hour, week, month, or year. Suites at Madison, where business gets done. Check them out at www.downtowntampaoffice.com. Now, on to the show.
You are listening to the Invest Florida Real Estate Show, covering topics in lending, buy and sell strategies, property management, hot markets, and tips and tools to guide you along the way on your path to real estate success. You want Florida investment real estate talk? You have come to the right place. And now, our hosts, Eric Odom and Steven Silverman.
Hello. Welcome to another episode of the Invest Florida Real Estate Show. This is your co-host, Eric Odom, along with Steven Silverman. Steven, we're making our way through the new year. It's it's hard to believe we're almost through the first quarter.
Yeah, I mean, just time races by and the weeks go by so quickly that, and as brokers, we're running around all the time on a treadmill. So the time does pass quickly.
Oh my gosh. I mean, at ROI, the brokerage, we're adding more and more people. We've got 2 more agents starting. We just added another agent not that long ago. So we've got 3 new agents starting the first part of this year. And, they take some resources. And I think some of it's an eye opener for them. They think, agents, all they do is just roll in wheelbarrows full of money. And it's not always the way it works. It's a tough road for agents, particularly when they're getting started.
Yeah, at Tampa Commercial Real Estate, we've done some really great deals this year, but people think brokers are always doing these great deals.
Big deals. Everybody's making too much money.
Deal, yeah, and you're making too much. Sometimes I come home and shake my head. I was working on one deal for the last 3-4 weeks, and everything was gung-ho, and we was closing, and the pressure was on, and calling at home, and got to make the deal, and then just Monday morning they said they changed their mind, and so that's a lot of investment of time and energy. Brokerage isn't always the fun part.
No, I mean, many times we have 100 hours into a deal that falls apart. How many of you guys would like to work for 2.5 weeks for free and then have a deal blow up on you? And folks, the first thing you want to do is try to negotiate the real estate commissions. I'd say 3 out of 4 deals that we get engaged in never end up happening. And it's just the way it is. And so when you try to explain to people that are the nature of the beast of what we do, and we have a lot of hard costs and it's the soft costs too. And, it's hard for people to understand that, for our business, and it's not all rainbows and unicorns, Steven. It's sometimes there's some hard knocks to this business for sure, but we've been busy the first part. It's hard for us to really complain about it. It's just you do get on a little run sometimes where more than your fair share gets canceled, and then all of a sudden you're going, how did I work the last month for free?
Yeah, you got to take the ones that work well, and a lot of it's going by instinct and working with people. Where you've got to build those relationships because everyone needs to know where the other players are.
Yeah, and folks get insulted when they call and they want assistance, but the reality is that most agents that have been in the business for a while will pick and choose the assignments they will take based on their assessment of whether they think they're capable of closing or not. There's no agent that's just sitting around that's been in the business for a while that's just waiting for the phone to ring for somebody to take their time for free. It's not the way it works. But anyway, I mean, like I said, we can't really complain. It's each day is another learning experience, and you learn from each one of your clients, good and bad. We had a great guest today, Steven. We're talking with a guy who's been in a lot of different forms of investment, and now he's focusing on multifamily here in the state of Florida.
Smart guy because he looks at the world from a 30,000 feet high perspective and then decides where he wants to zero in.
Yeah, he's here in our area from the Northeast, and we see a lot of activity from folks coming in from outside of the state, and we're anxious to hear what our guest has to talk today about the Central Florida market as it relates to multifamily. Wanted to read a quick review that we had on our website. Margarita from Miami, she says, "Love the Anna Bozovich episode. More Miami, please." Margarita, thanks so much for taking the time to leave us a review. That's great. We try to tell you every show. It's a lot of energy that we put into trying to produce this show and get guests that to come on the show that they want to invest time with us, and that type of commentary helps us a lot. And before somebody decides they're going to want to spend an hour with us in prep time and interview time, and also there's some trepidation about wanting to come on the air and talk, those types of reviews really help us. So if you've not done so, please go to the iTunes store or go to our website and leave us a review, leave us a message. It really helps us trying to do programming for the show, and it helps you as a result. Stephen, anything else before we get rolling?
I think we need to roll. Today we have with us San Eng. San is the CEO of Skytian Capital. Sam does a lot of things. He's an owner-operator and has been the lead sponsor in several real estate investment projects. He also has handled passive real estate investments. He was educated at the China-Europe International Business School, which is one of the top 4 business schools in the world, and attended undergraduate at the Wharton School of Business. He has written a book on Amazon, which is a bestseller in the investment category, called Commandments of Investing, Guiding Principles from the World's Greatest Investment Wizards. As a professional investor, he has raised and deployed hundreds of millions of dollars in infrastructure, technology, consumer real estate deals, and has run VC funds in China. Sam speaks 3 languages, and we're pleased to have him with us today. Sam, welcome to the Invest Florida Show.
Great to be here, Eric and Stephen. Thank you for having me.
San, really appreciate the time that you're investing with us today. Why don't we start at the beginning, the genesis? How did you arrive where you are today?
Wow. Okay.
That's a big question, huh?
Yeah, it is. I guess from the intro, you can tell I'm quite old, but you can say I split my life into 3, sort of version 3.0. Version 1, I was a serial entrepreneur. I guess I still am, having started half a dozen technology and consumer-related businesses, both in the U.S. and China, including one that I raised some $60 million plus for. And then version 2, after that, I went into the professional investments business, starting and managing a number of venture capital and private equity funds, also in China and Asia. I took 5 years off to spend time with my kids, which expired just about 18 months ago. And so now I'm on version 3, based out of the U.S., and really working, I guess, the closest animal to it is a very modest family office, investing in multiple different asset classes, passively and actively in the multifamily space.
And you've got a book too. Would you want to talk about that a little bit too?
Yeah, the book is called The 10 Commandments of Investing, and it was published last November. It was interesting. It took about 12 years to write it. I originally wrote it with my brother, Edmund, who had many years of experience as a CEO of an investment bank, a publicly listed investment bank out of Hong Kong. And we were ready to publish. But when COVID hit, my 17-year-old daughter, Ia, and my brother's son, Timmy, who's graduating Columbia this year, read the book and said, Uncle, Dad, this is a really good book, but it's so thick and technical and boring. It's not going to sell. And you know what? They were right. So they ended up being my co-authors to rewrite the book, about 4 versions. And essentially what we did was we studied hundreds of investment wizards, the Dalios of the world, the Buffetts of the world, but also investors from China, India, and other places. And we tried to distill what they all had in common as guiding principles, which led to the title of the book, which is called The 10 Commandments of Investing, which it can be applied to real estate, could be applied to investing in Bitcoin, whatever it is that you choose to invest in. And so it was published in November. We hit Amazon the first week, bestseller. And then earlier this month in February, because it's trending quite well, we actually made USA Today. And we made number 4 in Wall Street Journal bestseller.
Awesome.
For the nonfiction category.
Congrats.
So again, it's pretty exciting. We didn't expect it, but we do think it's got good content. I just spoke to my publisher about an hour ago, and he's working on translating this into Chinese and Spanish and Korean, as well as getting an audiobook out in the near future. So pretty cool.
So, San, we won't get into all the details, and because we're going to do a podcast about real estate. But can you just tell us what the 10 commandments are? I mean, I'm sure like "Thou shalt not kill" is one of them, right? Or maybe, but just to summarize, so because it sounds intriguing. Sure.
Yeah. So obviously, we all know the 10 Commandments of the Bible, and the 10 Commandments of the Bible are classic and enduring and universal because they are sort of guidelines that are applicable to everyday life, right? And so the 10 Commandments of investing is akin to that, except obviously we apply this to investing, whatever you choose to do in terms of investing. So the first one is know and be true to thyself. I mean, this is kind of like finding your passion, finding the area you want to work. Commandment 2 is owning your space, meaning you have to dedicate the time to the space. These all sound fairly basic. We have a lot of good stories and whatnot. But you can kind of see it in GameStop and other areas. All these young folks are basically looking at TikTok to invest. You know, when we say own your space, it means committing the time so that you develop something called independence of thought. So you can actually look at TikTok or Wall Street Journal, but obviously have your own opinion to determine whether that you think that's real news or fake news and make your own judgment. 3 is respect the market, which is a lot bigger than most people think. We did a study. Most GPs, most fund managers, whether you're VC or real estate or not, tend to think they are smarter than they are. But a lot of returns are actually by betting on the trends, right? So really betting, going with the flow as opposed to against it, right? So for example, when I started my venture capital and private equity fund, China was a rising tide. We were fairly early. In fact, I set up one of the first funds in a number of Chinese cities, and because it was growing so fast, you know, even an idiot could make money. Right. So you have both the beta play as well as the alpha generation play. Commandment 4 is don't be a dead fish, which is similar. You know, you don't want to be doing what everybody else is doing. Really is getting your own thinking in. Commandment 5 is seeking religion. Again, this all ties in. It's got a process in terms of finding your not only your passion, doing the homework, getting your own independence of thought. But once you have a conviction, a religion on a trade or stock or an asset, then you go to Commandment 6, which is waiting for the right timing, pricing. Once you have that, be bold and really bet big, right? So George Soros talked about that when he bet on the British pound. I'm doing it right now when I'm seeing such amazing deals in Central Florida. So once you've done all the homework, Commandment 6 says, you know, really, because you already know what you're doing, you already have done the homework, then don't be timid about it, right? Really, these good deals don't come that often. Commandment 7, which almost every successful investor we interview talk about, it's called Marathon the Winners. Most amateur or unsophisticated investors tend to say, well, I bet on Amazon, I bet on Tesla, it's gone up 100%. I should sell the stock. I should take the earnings. The ones that really make money, whether it's Buffett or Kathy Xu from China, they actually hold on to them. Unless the thesis has changed, there's no reason to sell Marathon the Winners and let it compound. And then the last 3, Commandment 8 is diversify, don't over-diversify. This is quite controversial. A lot of people think that you need 20, 40 stocks or assets to diversify. People like Mark Cuban, some of the most successful investors, again, Buffett, Kathy Xu, who's a VC of the year in China, they don't get into so many stocks. They get into a handful. They get into maybe a dozen stocks they know and follow. Commandment 9 is don't lose money. We have a great chapter on that works through the math that, you know, if you lost 50%, how much more you have to gain back up. Really making sure that you're investing with a margin of safety. And then Commandment 10 is the mind your mind, which is really the discipline. Again, whether you're Ray Dalio or anyone else, all the investors seem to have a strategy. They do the homework and they follow a certain mindset, leveraging things like meditation, whatnot, to make sure that they stay very focused. So very, very simple, but these are the 10 commandments that out of hundreds of people that we study all over the world are what make them successful. And I'm applying this to my current investing as well. And so far, so good.
Awesome. Let's talk a little bit about, actually, why don't I back up a little bit? You and I have connected probably about a month ago. Why don't we talk a little bit about that? I think it's important for the listeners to hear.
Sure. Well, I'm a fanboy of Stephen and Eric and your podcast. I think you guys produce fantastic content, have some great guests on. So I'm honored and humble. Thank you for that. But, this is just part of my, again, following the 10 C's, 10 commandments is really doing the homework, right? I've decided to deploy my own capital into multifamily. I started looking at both U.S. and Canada, where I have homes. And when I decided I wanted to do the U.S., I channeled this down to 5 or 6 markets and ultimately spent quite a bit of time in Florida. It's not the only place that you can make good money and good investing, but Central Florida is one of the top markets, if not the top market in my view. And so really the past 9 months, because of COVID as well, but because I like to see the properties in towns, I have driven 4,000 miles on my Tesla X, and I put in 11,000 miles on my Tesla Y, seeing every nook and cranny of Florida for myself, and obviously different properties and meeting and networking. And as I drive, I listen to your podcast and I learn as well. So thank you for answering my email.
Yeah, hey, no worries. And that's really the key, is that you reached out to us, and shockingly enough, I responded to you. Like, people think that sometimes that we're not approachable, and we are. We like speaking to our listeners, and we actually have done deals with some of our listeners, and we're always welcome that opportunity to chat with anybody who listens. And so we appreciate you, San, you reaching out to us, and of course, Stephen doesn't get a lot of compliments, so he's very appreciative of you complimenting him, because besides his mother, I'm not sure there's a lot of people who think highly of him.
Yeah, and I pay her,
and she's paid, and she's paid. So I mean, there's this is good. It's good for him, for his confidence. Then, why don't we talk a little bit about how you decided on Florida? And you mentioned Anna Bozovich, that you'd listen to her, and you probably made the decision to come to Florida long before her, but I think she might have made an impact in terms of your decisions.
And Anna's been on our podcast also.
Yeah, absolutely.
Yes. She was quite good. I'd love to reach out to her as well. When I decided to do multifamily, I'm invested in a lot of different asset classes. So I'm in farmland, crypto portfolio for a few years now, obviously equities. Invested in VCP funds and hedge funds, and invested in other real estate sponsors. These are all passive, but because my kids are all in high school and I have time, I need to do something. And I found the real estate business interesting and fun. So I started with my brothers in New Jersey doing smaller 2 to 6 store BERT, which is fantastic, infinite equity returns, if you know, returning the capital once you rehab. But I found that I'm more of a deal maker. I like larger deals. I've got a strong financing background. And so I joined some groups, for example, the Sunrock group, where we met and networked with the whole slew of people all across the nation.
Yeah, that's Brad Sumrock. Yeah, Brad Sumrock, right?
That's correct. That's Brett. He's got a great program. Not the cheapest program, but very quality people. So reach out to folks, from Phoenix to Nevada to Dallas to just anywhere, Carolinas. And again, there's probably a handful of markets based on net migration and jobs and tenant friendliness, tax friendliness that you would want to invest in multifamily. Florida logistically makes sense. But Central Florida in particular, if you look at net migrations and job growth, I think the latest one I saw is Redfin. It shows, Dallas and maybe Phoenix as the 1 and 2, Orlando and Tampa as 3 and 4. However, I look at Orlando and Tampa and other sub-markets, Central Florida as one market. If you added just 3 and 4, Orlando and Tampa, we are by far number 1 in terms of job growth and net migration. But the interesting thing is we're the only market in that list, I think the top 6 or 7, that has medium house income of sub 300,000. So it's obviously very affordable. So to me, it's very attractive. Obviously, it's a lovely place to be. I just came back 2 days ago from spending 12 days in Florida driving around. I brought my dog. He loved it as much as I did.
He didn't melt?
So, he didn't melt. He loves it. He loves it. In Toronto, he'll stop walking after 2 kilometers. At Clearwater or Dunedin, he'll go all day.
So San, I guess when you're looking at Florida, you're abiding by your principle, don't lose money, because you're figuring you're covering the downside because the trend is for increased population and increased job growth. So even if you make a mistake, it's going to rise with the tide.
I think it's very difficult to lose money if you do stabilize B and C asset classes all across the nation, but certainly in Florida, right? You're buying assets that are 95% occupied. The market itself, I've got 2 deals so far for Central Florida. The zip codes increased 15% last year, right? So just the market itself, what fund managers call beta. The beta is going 15% a year. You can do nothing and basically your asset will increase before the leverage 15%. Obviously, we're looking for ways to add value and force appreciation and generate alpha. And so you would have to do something really, really stupid to lose money.
We've met some of those people, but we certainly have.
Well, they obviously haven't listened to you guys or listened to your podcast.
We spoke with an investor wasn't that long ago, and I thought it was interesting that he called his switches, the light switch going on and off in terms of decision making, and he had a couple of what he referred to as switches, and if these 3 switches went off, then that would really get his attention. And so it could be anything from debt service cover ratio or value add or whatever it might be. What would be some of those switches for you, San, when you're looking at a multifamily deal?
Yeah, that's a great question. So I think multifamily as an asset class, even before COVID, I mean, the economy is going to crash at some point, right? I think if you look back at the headlines in 2019, everybody predicted 2020. And despite COVID, it did it, certainly in real estate. But it's going to go at some point. So I think Commandment 6, being patient, but meaning don't just do deals because everybody else is doing deals, that's important, right? So we just closed a couple of weeks ago a 76 store in Clearwater. I had actually made an offer. I was second in line last May. The winner had a much higher price but couldn't close. And so, we walked away. But September, they called us back. The broker called us back, and we signed the same day, and we got the deal, right? Just sometimes you just have to work a bit harder, but being patient. I think now that we have religion in multifamily and religion on doing deals in Central Florida because of all the things we just talked about, I think really being patient, but also doing the work so that you're in the flow. And then once it strikes, if you have to sign the deal the same day, sign the deal the same day, as long as it hits your criteria. I would say that's what I'm looking for. But it probably isn't as easy as it sounds. You guys know this, right? Last week, we made 3 offers from $12 million to $30 million. The $12 million had 20 offers. We didn't make best and final. The $30 million had 30 offers. We didn't make best and final. And we were pretty close to whisper price. The third offer was pending. We may make best and offer. So, the game is not a secret anymore. So I think the investors, the buyers have to find ways to win the game, right? And so we're evaluating that every single day. How to be more creative, how to be faster, how to be smarter, how to look more handsome, right? To get the deals.
So, San, looking at the overall picture, you said 2 things which in some ways are contradictory, and it's a big dilemma that faces all investors. We all know that at some point there's going to be a correction, and yet at the same time we want to buy. So it's like those 2 forces pulling against each other. Because do you have any feeling?
Well, this is the other thing I think has got to be tied in along your line, Stephen, which we have a $1.7 trillion stimulus that I'm not so sure it's necessary at this point, but here we are. I mean, I think politically they had to do it. And so we're all sort of waiting and holding our breath for this pullback, and then you just have this. It's not even gasoline on a fire; it's like a nuclear bomb on a fire. With this, it's unprecedented amount of stimulus. So I'm going to be really, just to, the question that you have about what are you thinking going forward of like what are going to be the triggers, but also how do you factor in on this massive amount of stimulus that we've really had over the past 9 months, and like what that's going to mean for the next 6 months, year, 2 years for the real estate market.
I think the fundamental thing is workforce housing is still in short supply, right?
Correct. Big time.
So I think that's the fundamental truth and assumption of why I'm putting the majority of my own capital into workforce housing. Now, that may be mobile home parks. I haven't done a deal yet. It may be B and C. It may be smaller and bigger deals. I think the stimulus. Again, I'm not an economist, but obviously it would fuel more speculative buying that goes into stocks and Bitcoin, also real estate. But it would also make renters more able to pay. Real estate obviously is a strong hedge against that QE. I think last year M2 went up 36%. So in a way, owning these rental apartments is a hedge against all this uncertainty, right? I mean, where else do you go? I already have my Bitcoin. I can't be 100% Bitcoin, although some days I wish I did.
Yeah, it's crazy, huh?
Young people can, but I've got 3 kids. I got retirement. So Bobby Lee, a friend of mine who is the chairman of the Bitcoin Foundation, suggested putting 5% in Bitcoin, and that's aggressive. I have a lot more than 5% in Bitcoin, but it's not 100%, right? So what else can you do that has cash flow that appreciates 15% a year naturally? And can be an inflation hedge that's 95% occupied. I think there isn't that many assets out there that can still do that.
Right.
Yeah, I mean, because in real estate we look at the trends, and some of these trends, like for instance, industrial is so strong at the moment, as is multifamily.
And any kind of residential.
What's the runway on some of these others?
It's Stan. It's and just to again to continue on with Stephen, it's been insane. On the residential side, it's been insane over the last, like eye-popping in Florida over the last year. At this time, if you can go back and turn a clock back to March 2020, Steve and I were sitting here wondering whether we were going to be around. Because what we saw on the horizon with what was happening with COVID and the imminent shutdowns, we were very fearful of what the next year was going to bring for us. And the only thing it brought was extraordinary inflation of asset prices in our market, particularly in the industrial side and on the multifamily side. And so here we are staring at another large stimulus. Plus, you've had this acceleration, not a deceleration, but an acceleration of people from the north moving into our area and scooping up residential property. So we look at it from our standpoint and say, okay, this is not going to stop. In fact, it's probably going to accelerate as COVID slows down. And then you have this stimulus is coming on top of it. We are anticipating that we're going to continue to see not deceleration of asset prices in this area, but acceleration of asset prices. And I don't know how you feel about that. If you can add something to that or say that I'm wrong, we're interested in hearing what your thoughts are.
Yeah, when you say insane, you talk about asset prices and multiple bids for houses, big or small. Is that correct?
Yes, and
the question is, how is that sustainable? Because it's so crazy already.
Yeah, and then not only is it sustainable, but we've kind of seen these asset bubbles before that have occurred in Florida. They always end with like and it's severe acceleration, extreme acceleration, and then a capitulation. And we look back in 2008 and 2019, I guess 92, and Stephen, I don't know if you know this or not, but there's dust that thinks that Stephen's old. So he's seen a lot of different real estate cycles, and so I have too. Not as many as Stephen, but I've seen a lot of them, and it's we see what's happening right now, and there's always been this move of people wanting to come to Florida, and we've had this continuous growth that's the environment that we live in. But then you've got this added stimulus, and so we're just kind of curious, is it going to follow similar patterns before? Is there something different on this one that maybe it's not going to follow this pattern of extreme price acceleration now that we've got the stimulus and the end of this crazy COVID thing?
Yeah, it sounds like Steven's an expert. Love to hear his views. I think for me, I've had a lot of opportunities to do development, good deals, and also do single family, for example. I have shied away from those because I see those as riskier. I shied away from doing A-class because I feel if the recession does come, it's harder to justify. So for me, yes, I'm concerned about the QE and the asset inflation. I think though I look to the comforting thing is if I'm buying an apartment building like this Clearwater one, is there a demand for the apartments? Can I raise rents? Right? What is the demand supply situation in that zip code, in that town? And so obviously not all will be fundamentally strong. We are sticking to our guns to buy multifamily that are in areas that has waiting lists and demand still, right? And also some areas that add value. So hopefully I'm right, but I think that gives us a bit more margin of safety. And obviously buying it at prices that still has the cash on cash and the IRR requirements that we're looking for. I don't know, but so in a severe recession, Ray Dalio says this is worse in the 1930s. He may be right. What would happen to B and C class housing?
Well, I mean, I always feel that like people always need somewhere to live. The sectors we have to really think about are like what happens with retail, what happens with office. We've got so many changing pieces going on now, and industrial cannot continue like this. It's, I feel like you're choosing the safest kind of sector because people always need places to live. It's the hardest space to play in right now because you just can't find properties.
And exactly what Stan was talking about, Stephen, with the teachers, the firemen, the police. Where are they going to live? There's an extreme shortage of it right now. And we're not the only ones that are having the issue. You have acceleration of land pricing, and it's causing stress because the values of real estate are increasing faster than these folks, the working class, their wages are. And so, developers aren't particularly interested in going out. And we know this because every developer we talk to tells us the same thing. They're not interested in building those. They want the super A class. And so what are we going to do about the workforce housing? This is what San's talking about. They're not developing it. They're not building any more of it.
Well, I think San's smart. You're doing the safest assets where, people have to live somewhere regardless of what they buy or what they manufacture.
Yeah. So even if you're looking at a downturn, that B and C class property is still going to is safer, of course, because we don't have enough of it as it is now.
I think there's quite a few friends doing development in Florida, and I think they will do well. Not to say that I'm smarter and stabilized. I just don't want that uncertainty, even though the development would and should provide higher returns, right? What I just don't want to do is on a 2-year development plan, something bad really happens, then you're stuck with an empty plot of land or half-finished building, and then all the returns evaporate. For me, if I can get 10% cash on cash though, and 1.5 to 2 times the money as a passive in stabilized B and C, that's good. You let that compound, right? That's nothing to sneeze at, right? Even 8% cash on cash, 1.5 times for an asset of this quality of risk. Who would complain about that? Yeah. Well, the people that are betting on Bitcoin and GameStop would complain about it, but is that sustainable?
or Rocket today. Good Lord, Rocket's up like 71% today. RKE, is that what it is? Rocket. Anyway.
Oh, really? I didn't. Okay. I'm a fan of SpaceX. I've been trying to get shares of SpaceX, but no luck yet. So let me know.
Okay.
So.
Talk to us a little bit about equity. You've got the family office. Is all of your equity derived from the family office, or are you leveraging that equity with other partner equity? How are you handling that, San?
Again, we're a very loose family office. I've got a few brothers, so we work together. My brother in Hong Kong unfortunately passed away last December, but he ran CEO a public investment bank in Hong Kong. So he was one that kickstarted me in the book, and so he did most of the public stuff. And then I've got two brothers in New Jersey that have been doing real estate for quite some time, and we do bird here. One brother has been doing smaller family birds for 20 plus years in New Jersey, never lost a cent. Some deals have refi 6 or 7 times, each time taking the money back. So those are from, if you dig into the numbers, what other asset class gives you infinite returns, right? In 6 months after you buy and and rehab it, you get all your money back plus another 20-30%, and you own the asset with net cash flows. Those smaller projects are great from a number standpoint. So those, and then the passive investments, whether it's in crypto or farmland or VC funds. I'm also in a bunch of Canadian mortgage funds passively. Those are all own capital, and the birds own capital. The Florida deals are getting larger, and the 76 stores, we did take some friends and family money, but it wasn't a widely published. It was a small deal, right? It's less than $8 million. If I get to a $30, $50 million deal, we will either syndicate or go to one of my previous LPs from my VCPE fund to take it out.
Gotcha.
But we put capital into every single deal. Otherwise, it's less fun.
Understood. So management, how are you dealing with that? Because really in New Jersey, you're operating as an asset manager, I suppose. So who's doing boots on the ground, showing the properties, overseeing maintenance and that sort of thing? How is that being handled, San?
Yeah. So currently I only have one live in Clearwater. That's the 76 stores. I was lucky enough to invest it in two gentlemen here in Jersey last year. They have maybe 400 doors here in the Northeast, and they're just incredible operators. So they're vertically integrated. They manage as well. So for the Clearwater deal, I found a deal and I brought them in just because they're such amazing partners. So we're equity partners, and they are managing the asset. They both spent time and lived in Tampa. One gentleman was a fund manager for a Tampa-based PE fund, and another gentleman actually played for the Buccaneers. His name is Brian Leonard. Oh, yeah. So they know the market decently well.
What method are you looking to find properties? Are you contacting yourself to try and contact owners, or are you looking at what's publicly posted? And
I'm known as the promiscuous Chinese guy with a white Tesla driving around all over Florida in every nook and cranny. I say that only half jokingly, gentlemen. I not this trip. This trip I was a bit more modest. The trip prior last month, I literally over a course of 10 days drove all over Central Florida. I looked at 80 properties, 8 a day, anything from 10 doors to 500 doors, and then typically after 7 or 12, 13 days of looking, I make a couple of offers and try to win one. But the sourcing of those offers came from the brokers. We have a small team that helps slice and dice the brokers. We try to network with them. To be very honest, we haven't been as successful in landing the big deals as we like. Last year, I think we did 12 LOIs. Because there was a stretch where we didn't come down because of COVID, but I think second half we 12 LOIs in the sort of the $15 to $50 million range. We made best and final in 3 offers. We didn't win, and then this year I think we've made 5 offers so far in the larger ones. We didn't win. We will win. We'll get something, but it has to fit our numbers, right? We're not going to win just for the sake of winning. The smaller ones are easier. So the 76 actually was a 44 that we combined with an adjacent 32. So each of the 44 and 32 were the high 5 cap going in place cap. But when we bought both at the same time and merging them, obviously we can eliminate a whole bunch of expenses, and the in place cap was 6.6.
Interesting.
And so now we're redoing the amenities. We have a larger space now to add a doggy park. We're rebranding it. We're doing some rehab. So that asset is going to perform amazingly. So a bit creative, right? A bit more work, but that's okay. That's okay. It's not, you spend a bit more work, you make more money. The second one under contract we haven't announced yet is interesting. It's a portfolio of 20 waterfront condos, all 20 are waterfront, 100% occupy. We're buying it for $228 a door. And in that zip code, in that town, which is my favorite town, Dunedin, there's nothing that is waterfront, 2 bedrooms that sells south of $300,000. So the strategy there is to buy the portfolio and then sell a few of them to bring some capital back so we can reinvest, but keep the rest as a longer term hold. So we're trying to make alternative ways of getting good deals.
Yeah, be nimble and flexible. So San, one thing I've decided while listening to you, as I drive now between Tampa and Orlando, if I see a Tesla, I'm pulling over to the side of the road just to get out of the way. I want to be safe.
Yeah, but it's a white Tesla with an Asian guy hitting all these neighborhoods that have no Asian people. But why is he back again? Why is he always driving around?
Yeah, he's stalking us.
He's stalking us. Yes. No. I think again, Googling is fine. We obviously read the OMs, we talk to the brokers, but to get the nuance, it's really difficult to really make a good offer unless you've seen it, right, and seen the neighborhoods.
I think that's great advice for all investors. You can't do everything on the internet. So, San, if people want to reach you and get more information, how can they contact you?
Sure. I think just my website, Skytian Capital, SKYTIAN Capital.com. It has links to all my social media. I do have a podcast for the book with my daughter. And following your footsteps, we are in Clubhouse every Wednesday night talking about investing in Florida. So hopefully you guys can join as a guest, an expert speaker for us in the coming weeks.
Awesome.
It's a bit more unplanned, but we go and have some great discussions. Rod Cleef came on once, and Brad Summer also came on once as well, just to share the views.
You got some great people. I'm not sure we belong there. Eric, I'm not sure if he can come. I'll come.
Yeah, if you have another 30 seconds, I'd like to share a deal that we lost. It's very interesting.
Yeah, let's hear it. Let's hear about the deal you lost. And then also I want our listeners to know what exactly you're looking for, because we do have a number of brokers and agents that also listen. And so if they come across something, or maybe somebody who has a partnership deal with you, we'd like to hear about like what you're looking for too, more specifically. But go ahead. I'm sorry to interrupt. Go ahead and tell us about the deal you lost.
Sure. Yeah. So in May, I did the whole drive thing, and there is a property. It's a 32 unit on almost 2 acres, just at the tip of historic Northeast, a couple of blocks from Trader Joe's. You know the area. It's a beautiful area. Yeah. And it was interesting. That asset was in Luton and Crexy, and it's been there for like 360 days, over a year, or 368 days. And my first couple of trips, I just didn't go. It didn't make sense because the broker marketed it as a redevelopment project, right? So, and in fact, the ad said, if you're looking to buy it, you must look to develop it. First few times I didn't look at it, but then later on in May, I looked at it and I said, actually, these are 32 units that are averaging $600 a door in the northern part of the historic Northeast. What if we look at this as a cash flow project, right? And so we ran the numbers. We said, oh my God, we could do nothing and lift this to 800, 900, right? The studios and 1 beds. So we got into a verbal handshake for the offer. We lost the deal because one of the, I guess this triggered one of the friends of the owner, and he came in last minute to do an all cash deal, only $50,000 under.
Ouch.
So I guess the lesson from that is, sometimes the brokers, they're not like Eric or Steven. Sometimes the brokers don't necessarily accurately represent it, and you have to really know the market and the asset and what you can do with it. That asset would have been an amazing, 600 to 800, 900 bump up without rehab. And with rehab, it would be cash flowing like mad, right? So I still kick myself for not moving more aggressive in that one. But I think that if we look harder, turn over some stones, we could still find those.
It's interesting also with, you talk about that. Most folks will look on LoopNet and CoStar. They peruse those and spend a lot of time on LoopNet and CoStar. We find a number of deals on MLS because what you have is a residential agent who they might take a listing they really have absolutely zero clue about, and they're told to price it because that by whatever the owner tells them to price it at. And usually 9 out of 10 times it's priced way over the market because no self-respecting apartment broker would take that assignment on because they'll never be able to sell it. But the residential agent who doesn't, you might take one of these deals once every 3 or 4 years, has no idea and just takes the listing to take the listing and get some telephone calls on. That's it. But frequently you can see those deals that you've got an owner who's had it for 30 or 40 years. They don't know any better. The rents are way under market because they've owned it for 30 years. And then they've told a residential agent to list it. It's got all sorts of deferred maintenance, and they think no one's going to want it. And then lo and behold, you look at it and you're like, oh my gosh, what is this? This is a gem. So, and then the other thing is that on Realtor.com, which is the distribution point for all of MLS listings, they won't show anything over 4 units on or any commercial dwellings. And so these residential agents take these listings that don't even get published anywhere. And so, you get this no competition. So there's a little bit of a hack you might want to check out. Have one of your residential agents who have access to MLS set you up on a multifamily search, and then you'll get emails every day because you won't be able to find that stuff on the Realtor.com, which all of their traditional listings, and then you can peruse that stuff and occasionally find that stuff along with the expired listings. Can be really good.
Great advice. Thank you. Yeah. So we obviously are looking for larger deals. We're looking for a partner. I think we do have some expertise. We have capital. We have access to larger capital. But we're also looking for some of the smaller ones, like the Clearwater one. If we can combine, 2 30s and 40s into a nice asset, we could do those all day, right? So we're a bit more flexible in terms of the asset type, as long as the numbers make sense and we can do good. But the focus is we're very focused in Central Florida right now.
Okay, San, thank you for being with us. We're going to definitely get your book, The Commandments of Investing, and we appreciate the time you've spent with us.
Thank you. And Eric, we didn't meet up last time, but hopefully next trip we could all grab a good lunch.
Yeah, that would be great.
Meet in person. I appreciate your time, and thank you for having me.
No, thank you for your time, San. We appreciate it. And that was San Eng. Stephen, what were your thoughts about speaking with Mr. Eng?
Well, Sam was a fountain of information, and I loved the 10 points that he gave about investing. But he mentioned some really interesting things that stood out for me. First of all, he has the whole world to choose from. He's choosing Florida, and particularly Central Florida, over all other markets. And he's focused on B and C assets, and he's found religion, and that's where he's focusing. And he's an astute investor, and he's disciplined. And so it was illuminating to see that all in one place, and he put it in writing.
Well, it's always great to hear a perspective from somebody outside of the area, because we think about the increase in asset pricing, and for us, it carries different meaning than for somebody from outside who's looking at it just from a cold, calculated way. And he talked about the markets he was looking at. We're the only market that is sub 300,000 on the home prices. And so for me, it's like, even though we've had this acceleration, it's all relative, right, Stephen? And so it's a reminder when you have somebody who gets a fresh look from the outside that maybe the asset pricing that we have in terms of housing in this area is not what we see, because we're stuck in the weeds, and somebody giving us a fresh perspective from outside can put a different light on it and show that maybe it's not what our perceptions aren't really the reality. So good stuff. Good conversation with San.
Okay, so to our guests, please remember, for us to get guests like San who called us after listening to our podcast, please give us recommendations. Go to Google or the apps and just give us positive reviews, because that attracts really good guests like we had with San.
And we always appreciate somebody who's working in Florida or thinking about the Florida market, bringing their unique knowledge to the market. So, reach out to us. Let us know what you got. We're happy to talk to you. Steve, San was a great guest. For other great guests, where can listeners go to?
The one place to go is www.investfloridashow.com. Go to the website. You can download the app onto your mobile device and listen while you're driving or in the gym.
Guys, as always, we appreciate the time that you invest with us each and every episode. And until next time, hasta la vista.
You've just listened to the Invest Florida podcast with Eric Odom and Steven Silverman. Join us every week for actionable real estate investment ideas, and of course, visit our website at www.investfloridashow.com for more shows and tips on how to earn a cash flow in the real estate market in Florida. While hosts and producers of the Invest Florida show have no reason to doubt the validity of comments of our guests, we do not warranty their accuracy. Please check with your legal, financial, and tax advisors before entering into any investment. Returns will vary from person to person and deal to deal based on unique circumstances. All information expressed in this show is for educational purposes only. Opinions of the guests are not necessarily shared by the hosts and producers of the Invest Florida show.